For now, business is proceeding as usual between Kenya and Tanzania. But in the wake of the latest row between these two East African lovebirds, we simply cannot ignore the dissatisfaction, the squabbling, the backstabbing and the dissatisfaction between the two parties and what exactly has sparked it. We'll be going deeper into the issues between the two countries in detail tonight on Global Business Africa. But that is not the only thing on the agenda. Kenya's sugar farm sector. What ails it? How can it be fixed? And we'll be looking at the intricacies of searching for oil in Somalia. Now, after a dramatic escalation in a cross-border trade round last week, ministers from Tanzania and Kenya will now be meeting in Dar es Salaam in April to iron out persistent issues which have put these two countries at odds. If there were essentially two lovebirds on Facebook, the relationship status would be it's complicated. Bilateral relations have been slowly souring over the years, but matters took a fairly dramatic turn last week after Tanzania's Civil Aviation Authority cut the frequency of Kenya Airways flights to Tanzania by 2/3. As part of moves to ratchet down tensions, however, Kenya's Minister for East African Affairs, Phyllis Kandia, has been quoted in Kenyan media confirming that vehicles from Tanzania will now be allowed to get access to the Jomo Kenyatta International Airport. In return, Kenya Airways got its original flight frequencies to Tanzania restored with effect from the 26th of March, even as these two countries continue to iron out outstanding issues once and for all. Now then, let's get to the heart of the matter. Kwame Owino is the Chief Executive Officer of the Institute of Economic Affairs. He's with me in studio right now for a deeper analysis of the persistent rows between these two parties. Mr. Owino, you've proposed that Kenya should unilaterally take steps to essentially open her borders and to open up her markets to her East African neighbors without reciprocation in any way. How will this work in practice?
Well, I think the reason for this kind of proposal is, let's ask ourselves what's the problem and what concerns the other East African partners, but more particularly Tanzania. One of them is the fear that Kenya's businesses may have a predatory intention and to go out there and actually dominate these economies which have much smaller businesses in comparative terms. And so the way to do it is actually to show that the East African community and the East African customs union is not necessarily meant for any predation, but actually to allow for easier business flow and the principle of allowing for a common market. So it needs to make sense. And the only person who can actually make that in a convincing way is Kenya. And to offer this to the rest of the East African community partners would be one good gesture. So basically it would be both enhance in terms of principle the question of increased openness, but the other one help to with the symbolic gesture of showing that, look, our intention is not to dominate other countries at all. I think that would be a good thing for Kenya to start with.
From a technical perspective, this is entirely possible because in any case, that is the entire end game, the end target for the East African community as a whole. But from Kenya's perspective, are political considerations the main reason why Kenya's government hasn't done this yet?
Yes, it's political considerations, but on both sides as well. I think as I said, even within Tanzania itself, there are specific businesses or even specific people who have the concern. And I think it comes from the view that opening up of markets and is about exchange of one favor for another. Now, that's a very inefficient way of doing it. It definitely is going to slow down progress. So the political considerations are there, but my view is that the negotiations are done by the sovereigns who are political, but the trade is actually done by is conducted in trade and services and goods is actually conducted by businesses who would see the logic for this kind of thing. And Kenya's businesses, in my view, have nothing to fear, knowing that kind of gesture would actually just mean that everybody would have to come along in due course.
Speaking of red herrings, Mr. Owino, let's focus on one particular one. There's been a lot of arguments being made about this particular row, that this is some sort of expression of regional rivalry or jostling for supremacy, especially with regard to efforts to making either Tanzania or Kenya a transit and logistics hub for the region as a whole. But that whole thing, that entire argument is just one big red herring, isn't it?
I think it's a red herring, but also based on incorrect analysis of what the situation for both Tanzania and Kenya are. None of them is likely, given the infrastructure that they have and the size of the economies and at the same time the size of the land, none of them is bound to be the biggest hub. largely because I think they are more or less in the same place. Of course, Tanzania is building infrastructure and so is Kenya. So the likelihood of anyone running away with the logistics hub price is unlikely, just given the historical basis. So, but I think that what could be more possible is for Kenya to be the connector for the rest of EAC into North and West Africa, and Tanzania will be the natural one for the connector into Southwest Africa and to the west of Africa in general. So they should see these hubs as smaller hubs within the bigger one. And of course, if they manage to connect the two, then that's a good thing. But it doesn't inspire confidence for planes and small cars to actually be stopped from crossing borders one way or the other. So yes, hubs will develop, but my thinking is that they'll develop with a different focus. Kenyans will be looking northwards and west, and Tanzanians will be definitely southwards towards South Africa and a few other smaller economies, and to the southwest of the East African community in general.
Right. One last question for you, Mr. Wino. Kenya and Tanzania, they're having these regular tiffs on and off over the last couple of years, but they're also involved at the moment in talks to set up the tripartite free trade area, which would essentially merge COMESA, EAC, and the Southern African Development Community as well. If these two parties can't agree or see eye to eye on such simple things now, aren't these disputes likely to bleed over into talks to set up that tripartite FTA?
That's definite, I think, because EAC is touted as one of the most successful within the continent. And so if the two biggest economies and obviously the biggest in terms of land size within the EAC cannot get together to solve a small problem of vehicles crossing land spaces, then obviously that will not be, it doesn't portend well for the bigger one. I think the political contest will continue, even the business contest will continue because of the fear of competition. But if the EAC cannot get it together, I think the rest of Africa in terms of the tripartite agreement is a pipe dream, to be honest.
Indeed. We'll have to leave it there for the time being. Thank you for your insights. We've been speaking to Kwame Owino. He's the Chief Executive Officer of the Institute of Economic Affairs, a think tank based here in Nairobi. Now, we did discuss the trouble with the Kenyan sugar industry in detail on Monday evening's show. Today, however, we're going to look at the same story from a different perspective. We'll be visiting sugarcane farms in Western Kenya, where farmers are struggling with a decline in the price they're getting, not just for sugar, but also for the cane they deliver to factories. Farmers say despite trade restrictions being put in place to protect the industry from cheaper imports from COMESA producers, they're struggling under mismanagement and smuggling. The country's largest producer, Mumia Sugar, has been bailed out by the government, but experts say Kenya needs a far bigger, more integrated set of plantations and more extensive reforms to the sugar industry.
In the sugarcane fields of Western Kenya, farmers complain falling prices mean they can barely make ends meet. With much of the production coming from small rain-fed plots rather than large irrigated plantations, the costs are much higher for these sugarcane farmers than rival African producers. And the country's much higher altitude means its growing cycle can be up to 24 months, double some of its competitors. Mumia Sugar, which accounts for 30% of Kenyan production, symbolizes much of what is wrong with Kenya's sugar industry. The government, with a 20% stake, poured more than $5 million into the firm in January. Executives were sacked after an audit prompted investigations into sugar sale and importation transactions.
The company has really changed. We don't know how the factory functions because at times it's okay.
The government has sought to protect the industry since 2003 by limiting imports. But critics say that instead of making it more efficient, the protection has fostered mismanagement and smuggling. It's also delayed reforms such as privatization and modernization of an industry on which 4 million Kenyans depend. Elikeya is a farmer in the Western Mumias region who still tills the land his father has worked on since 1972. He says he's suffered from the sliding sugar price.
The proceeds started coming down. You know, as farmers were paid per tonnage. So even the tonnage went down, the price per ton also went down, and the returns I was getting as a person, as a farmer, really went down.
Kenya's problems take place amid a difficult global scenario. World benchmark sugar prices have struggled over the past 4 years against a backdrop of excess supply, with ice raw sugar hitting 6-year lows last week.
At the moment, it's a sour business, but it's a sweet business to the business people. These are the sugar barons. The sugar barons would like to take this advantage will even agitate for existence of this situation so that they can take this advantage to the detriment of the community, to the dependence of the sugar industry. And these are the farmers.
Despite the problem, Mumia Sugar has diversified. It's using molasses to produce ethanol, which has industrial and fuel uses. It's turning byproducts of sugar manufacturing into electricity, with a 36 megawatt power plant, 26 megawatts of which are sold to the national grid. Voldi Karolsa, CCTV.
As stability, law and order is gradually restored, Somalia has resumed the search for oil and gas off its vast coastline. Some Oil and Gas recently conducted a seismic survey in the country, but the results of that are yet to be made public. The federal government is also in talks with ExxonMobil and Shell to renegotiate and reactivate exploration contracts signed with the firms in the late 80s. Mohammed Irmoge has been documenting Somalia's hydrocarbon potential. He found this report.
Somalia is believed to have a huge potential in untapped oil, perhaps as much as 110 billion barrels. Soma Oil and Gas, a British company which has completed an onshore and offshore seismic survey, says the results are encouraging.
The information that we can tell based on seismic surveys shows that there are big structures underneath the Indian Ocean, onshore and offshore. That means Somalia is one of the most promising areas on oil deposits. In the coming 6 to 10 years, we would see extraction.
But Somalia faces a number of issues. One of them, a maritime border dispute with Kenya. Last September, Somalia filed its case with the UN's International Court of Arbitration.
We
didn't do any harm. We've only gone there to reclaim what's ours. We've had talks with Kenya for 6 months. We've had negotiations on maritime border issues. But we felt that those negotiations could not move forward. So we've decided to resolve this in a civilized manner.
At stake is the fate of potentially lucrative oil and gas reserves off East Africa and legal claims to sell rights for exploration. Another issue is the jurisdiction of oil concessions between the central government and the semi-autonomous regions.
There are political issues that affect extraction of oil. 1, the cooperation between the federal regions and the central government. 2, strong political stability is necessary. International oil companies need to see reliable stability.
This country doesn't have laws that define oil extraction licensing. This has brought a problem where the central government, the federal states and the semi-autonomous regions all negotiate and enter conflicting extraction agreements with private oil companies.
The Petroleum Act of 2008 states that resources from oil should be shared. What the minister is working on is how the resource is to be shared. The regional administration would be part of it.
Feasibility test is now done and multinational companies could soon apply for preferential oil blocks. The seismic survey results are out and the government has restarted talks with Shell and ExxonMobil to resume exploration in blocks they had concessions for in the late 80s. Question is, with all these conflicting sides, could there be risks if the development of petroleum resources are not carefully managed? Mohammed Irmoge, CCTV, Mogadishu.
Let's make a quick run through the equity markets here for you. Relatively mixed bag today as far as the equity markets are concerned. Losses in Egypt and in Nairobi. We're down to under 5,300 on the NSE 20-share index. It was only a couple of years ago that everyone was really pissed off at Safaricom. The shares were languishing somewhere around 5 shillings a share. Today, however, they've gone all the way up to 16. That's a 52-week record for that particular counter. And some investors there smiling all the way to the bank. Up next, we'll be looking at Tony Elumelu's ambitious plan to create 1 million jobs across Africa. We'll also be looking at the investment climate in Ethiopia, one of Africa's fastest growing economies.
Sustainable development and a commitment to developing partnerships with Africa. Some of the key phrases already used at the Africa Global Business Forum here in Dubai.
There is a need for a predictable environment in which investors have to put their money.
Welcome back. Our journey across Africa's business landscape still continues from the Kenyan capital, Nairobi. Now, the inaugural class of 1,000 entrepreneurs who will be funded and mentored by the Tony Elumelu Entrepreneurship Program was revealed in Lagos on Monday. They will be taking part in a $100 million program that aims at supporting 10,000 African entrepreneurs over the next decade, with the ultimate target of creating 1 million new jobs. Over 20,000 African entrepreneurs from 52 countries applied for this program. That number was eventually whittled down to just 1,000. According to the selection committee, the winning business plans represented different sectors in different countries and different economies, from agriculture to fashion to ICT and construction. The top 5 countries in terms of the numbers of winners, however, are Nigeria, Kenya, Uganda, South Africa and Ghana. And for those of you who don't know who Tony Elumelu is, he's an economist by training. He's a chairman of Heirs Holdings and the United Bank for Africa, better known by its acronym UBA. Now, let's get the latest details on this particular ambitious plan from Sophia Dangosh is live in Abuja, Nigeria, with more details right now. Sophia, let's start with some background here. What exactly inspired this program? All right, unfortunately, we're having problems with that particular link. Let's move on, however. From an economic perspective, Ethiopia is one of the most prominent success stories in Africa, especially over the last decade. Where else will you find a combination of average GDP growth rates in the high single digits, Africa's biggest dam, not to mention an expansive dam building program, and one of Africa's largest and best-run airlines? Now, the managing partner of Ernst & Young Ethiopia, Zemetene Nigatu, strongly argues that there's no better time than now to invest in Ethiopia. He explained why to CCTV's Deju Batmos.
There are 3 or 4 key sectors for investors, for global investors, and also investors from Africa to look at Ethiopia. One is manufacturing, especially labor-intensive manufacturing that could benefit from 2 things. Very cheap electricity. Ethiopia has the cheapest per kilowatt electricity cost of any country in the world, which is 4 cents, 4 US cents. The second part of it is affordable labor. So if you look at, for example, how China developed over the last 30 years, it was on the back of a very large productive labor force, which is now becoming affluent, which is becoming more and more expensive. So labor costs in China, for example, are becoming very high, whereas by contrast in Ethiopia, it's still about 20 to 30% of what it costs in China. So when you combine those 2, and of course, the infrastructural support that is being built, the roads, the power dams, as you know, Ethiopia is building the larger. Any industry that can take advantage of these elements, I think there should be. So manufacturing will be one of them. The second is, of course, agro-industry, especially value-added agro-industry. Not necessarily the farming, but the raw material that comes from the farm. It could be value-added coffee being exported to whether it's China, to Europe, other things, but anything related to agro-industry, because as you know, Ethiopia has a lot of fertile land, it's a very large country. That I think will be. The third part of it is investments in infrastructure. It could be ownership of some of these infrastructural assets, but also primarily, as the Chinese are doing, for example, coming in and helping build the huge infrastructural needs of Ethiopia. Now, these are sort of the 3 key sectors. In addition to that, of course, from a domestic perspective, but also from investors' perspective, is the tourism sector, untapped. We, for example, have the largest airline in Africa. It flies to China, it flies to all around the world. Last year, it made more money than all African airlines combined. That means it has built up huge capacity. On the back of that, you can build a very large tourism sector, not just Ethiopia-centric, but focused on the region as well. So if you segment it from manufacturing, agro-industry, infrastructure, tourism, and then of course, last but not least, is the resource play. I know at the moment commodity prices around the world have come down, but Ethiopia also has huge untapped natural resources. So when you combine all this, because a lot of people ask me, how was it Ethiopia was able to grow by 10.4% on average for 10 years in a row? Okay, these are some of the elements that has helped propel it. Huge investments in infrastructure, which is now going to start paying dividends to the private sector, both the domestic private sector and the foreign private sector, which needs electricity, which needs roads, the railways. Again, here the Chinese have played a very, very significant role. For example, they're helping rebuild the railway connection between Ethiopia and the port in Djibouti. And I was very happy to say that a month ago, I attended the inauguration of the first subway in Africa, in sub-Saharan Africa, built by the Chinese, but of course paid by the Ethiopians. So when you combine all these, when it's coming online, the pipe, the hydroelectric, all these coming together is starting to attract very large investors.
Right, it seems we have cleaned up that signal to Nigeria. Let's go back to Abuja now. Sophia Adengo's on the line for us there. 1,000 African entrepreneurs, the ultimate goal here being to create 1 million jobs. This is very ambitious, Sophie. What inspired this plan?
Well, it seems the task really at hand here by this foundation is to initiate a thinking, a new paradigm shift in which young people, 1,000 each year for the next 10 years, are tasked with driving transformation economically and socially in order to see Africa in a new dawn of creating jobs as opposed to expecting them.
Indeed. Walk us through what happens now. We have 1,000 startups who have been picked. What happens next?
Well, it seems the 9-month course will be able to make sure that the young entrepreneurs know exactly what it takes to maintain a small and medium-sized business. That will require partnerships with a mentor and indeed following through on their business plans, and a $5,000 initiative that will be seed capital for them to be able to see their businesses grow from Pan-African to global competitors.
Indeed. The mortality rate for SMEs, however, across Africa does tend to be relatively high, over 50–70% in some cases. What sort of failure rate is the Tony Elumelu Foundation working with? What sort of failure rate does it anticipate among this class of 1,000 for 2015?
Well, it is true. Statistically, the breaking point for most small business owners is about 2 years. But the foundation hopes to mitigate these failure rates by indeed working very closely with some of these entrepreneurs and making sure that they have fully understood what the program's end result is, which is to bring about success. The hope is that none will fail.
Indeed. We'll have to leave there for the time being. Thank you very much for that. That's Sophia Adengo live in Abuja, Nigeria. Whichever way you cut it, that's a huge, huge bet right there. $5 million of capital at risk over the next 10 years. Should be fun to keep tabs on that particular program. Right now, though, quick run to commodity prices. Let's see what has been happening on this front. Oil down about 6 cents in trading or so earlier today. Some interesting arguments still going on between OPEC and non-OPEC members on who should cut, why they should cut, when they should cut, on whom it's fair to place the burden of lower revenues on. The soap opera in oil does continue. We'll keep you updated right here on CCTV Africa. We'll be in Washington, D.C. next, Little Ethiopia to be specific, to explore the culinary delight of Ethiopia in a foreign land. Welcome back to the program. Now, that defining element of Ethiopian food, injera, is winning converts far afield. The soft and spongy flatbread made from a grain called teff is in demand from Ethiopians living thousands of kilometers from home in Washington, D.C. As Daniel Rengis reports in Grassroots tonight, however, injera's latest converts aren't even from Ethiopia.
Of the more than 250,000 Ethiopians living in the US, the most concentrated population lives around Washington, D.C. They brought with them an exciting food culture, which for many Americans is quite different from their usual diet. It's even led to culinary tours in the capital's Little Ethiopia.
They have injera here where you can use at the end, all the flavor, injera absorbs all these flavors, and you can like roll it up and eat it like a cigar.
Miaza Zamedu owns a restaurant in nearby Falls Church, Virginia. She says business is being boosted by those looking to cut wheat out of their diets for health reasons.
Well, it brings us a lot of customers. Yes, those are people who are health conscious. We are getting a lot of customers because of teff also. You know, like a lot of people read about it, they've been writing about it, so it's good for business.
Celebrities like Gwyneth Paltrow and Victoria Beckham have promoted the health benefits of teff, which they regard as a superfood, boosting demand for the flour and for injera.
The secret of the success of restaurants like this one in the Washington, D.C. area is the fact that only 22 miles in that direction is Washington Dulles International Airport, where Ethiopia Airlines brings in fresh injera like this 6 days a week.
Because demand outstrips supply and raises domestic prices, the Ethiopian government has banned the export of the grain itself. So some US farmers are now growing teff, which they sell to food stores and restaurants.
I mean, it doesn't have to be necessarily need to be imported from Ethiopia. It doesn't have to. I mean, but of course there is a means to import it from Ethiopia, and there is enough in Ethiopia itself. Okay, otherwise we bake it here too.
The boom in these restaurants also provides an opportunity to promote other Ethiopian specialties like coffee, thereby spreading the economic benefits of injera's popularity far and wide. Daniel Renches, CCTV, Washington.
Right, quick run through the currencies here for you. Not much development on this front. The Nigerian Central Bank did hold rates at about 13%. Expressing got a bit of concern about economic growth moving forward, but the governor was optimistic that confidence and, of course, trading activity would resume once the elections are over and done with. The rand, however, riding a wave of emerging market currencies strengthening. The ruble posting gains, the real also posting gains, and it went up to about 11.8 to the American dollar. Now, here's what we're working on for tomorrow's program. Zimbabwe, they're planning to engage in talks with the Germans on how to resolve a $739 million debt that is due to Eurozone's biggest economy. We'll have details on that later on tomorrow. We'll also be looking at what is in reserve for the South African Central Bank. It has its Monetary Policy Committee on Thursday. Will they follow the route set by the Nigerian counterparts? Find out right here on Global Business Africa. But that's it for this edition of the program. We'd like to hear what you think about what we do around here. globalbusinessafrica@cctv.com is the email to use. Of course, Facebook and Twitter are also your ports of call. Thank you for watching. We'll see you in the next 23 hours. I'm Ramanyan.